Really move to the most important part. Now, let's talk about IFRS 15. IFRS 15 talks about revenue from contracts. Now, you know that when you start your income statement or your P&L and other comprehensive income, the first item that you see is revenue. And so it becomes very important to even deal with the first item, because if there are notes on the first item of revenue and you are not able to deal with it, that ends your story in the exam. You can't even start than to even finish. You are already in trouble. So let's deal with this one out so that, I mean, you can be able to have some confidence if you encounter the standards. All right. Now, the first thing we need to do, as always, is to define what revenue is. So definition. All right. Then we'll talk about recognition and measurement. Okay. So that is what we'll talk about. So what is revenue? What is revenue? Revenue is simply the income that you derive in your ordinary course of activity. Okay, it's an income. It's a gain that you income and gain that you derive from your ordinary course of activity. So then your main activity that you do, whatever gains that, whatever income that you derive from your main course of activity, that one is what we call revenue. As professionals, you don't need to confuse revenue with income, all right? Because revenue is a subset of income, okay? So there are incomes that you get in your ordinary course of activity, and there are incomes that you also, gains that you also get from activities like selling your old properties, all right? So you have your carrying amount, you sell it, you get your proceeds. There is a difference. You call it gain from disposal. Okay, that one is no revenue. It's an income, but it's not your revenue. All right. So the revenue is the part that you get from your ordinary course of activity. All right. And so that is why in your study in accounting or financial reporting, when you started, they will tell you that if there are things called other income, all right, because those things are not directly from your ordinary course of activity. Okay, so that is that. Now, the most important thing about revenue, we are breaking it into two parts. We are talking about the main revenue thing we all know, and the construction contracts, all right? So that is what we are looking at. Now, let's talk about recognition. In terms of the recognition, there are 5 steps approach to recognizing a revenue. There are 5. And this one, your examiner can test you on this 5 alone as a standard in isolation. Okay, and you need to know all the 5. Now, the acronym that we derive for the 5 is COPA. All right, so you should never forget is COPA. All right, COPA. Now, what is C here? Okay, C is what? Contract identification. There has to be a contract. Okay, there has to be a contract. There has to be a visible contract, or you see in here, you've already learned from IAS 37 that obligations sometimes can be contractual or legal. Herein is the same thing, okay? It can be contractual or legal. It can be paper document, okay? It can also be a contractual thing. For example, if so, you have a case where somebody pays payee for a supposed staff, Okay, you pay their pay every month. You give them their net salary every month. Yet there is no employment contract. Will you say the person is not employed? You have been paying him every month, but there is actually not a document, a paper contract. So will you say there is no contract between you and the person? The person comes to your office 8 to 5, but it's just that there hasn't been any document signed. Definitely there is a contractual contract because the activities of the two parties here, me coming to the office 8 to 5, you paying me every month. It's actually a communication that there's a contract. So it can be legal where you sign some things off, or it can be contractual. All right. So that is what we mean. O is for obligation. Okay, there has to be obligation. Okay, what is obligation? Obligation is actually the activities that you perform in the contract. Okay, so we call it performance. We are talking about the performance obligation. Here we are talking about the activity. All right, what each and every party is supposed to do, okay, in the contract. So like I said, my job was to go from 8 to 5. The other person was to pay me, so he's paying me, and that must come to play before we can say we can recognize a revenue or something. All right. So if in case you are selling something to somebody, there is an obligation. The person had to do something before he or she got paid. All right. So that is what we mean. Now P is for price. P is for price. So we call it the transaction price. Okay, what you are actually giving out for what you are receiving, the activity the person is undertaking. All right, so that is the price. And here we are actually looking at the money value. Okay, the money attached to it. Then A is allocating, so we call it allocation. But what are you allocating? Okay, you are allocating price here to the obligation. So you are allocating prices to each obligation. All right, so that is it. For example, here in Ghana, we don't normally see these things that much, but in the Western, you see that when they sell something to you, a product to you, inside the pricing of it is a repair component. So when you take it and you send the thing away, there is a repair component, say in a year, it can be repaired for an amount, okay? So that is, we can only take that money as revenue when we actually do the repair. If repairs is then not made, I mean, probably we have to defer the repair aspect because it is actually not revenue obtained. Okay, there is a service part of the product and there is a good part of the product. So you ask for the good, it has been sold, but the service hasn't been rendered yet. So I mean, you have to split it within the two and recognize those ones that you have performed the obligation. So if you have not performed the obligation of the service, you cannot recognize that as a revenue. So that is what we mean by that. All right. Then the R that you see here is recognition of revenue. So if those things here are fulfilled, then you go on to recognize your revenue. Please, so these are the 5 steps to recognition of revenue. These are your 5 steps. Now, that said, there are some things I need to bring to your attention about some specifics. All right, we have some specific scenarios I need to bring to your attention. Now, a typical one is agency sale. And most of the time, you see this one in your footnotes. They bring it into, test your understanding on revenue. Okay. When it's an agency sale, where you, the one preparing the account, is the agent, listen carefully. If you are the one where the person preparing the account is the agent, then the only revenue that you can recognize is your commission from the sale. Okay. Where the person, the reporting entity is the agent, your revenue actually is your commission. Okay, so that is that. But where the reporting entity is the principal, where the reporting entity is the principal, what you can do is to recognize everything and treat the commission that you have to pay to the agent as cost of sale. So there are two ways you do that. Either you treat the entire money as revenue and treat the commission that you paying to the agent as cost of sale, or you just separate the sale aspect, that commission sale aspect, and treat that one net off and treat it as other income. Okay. So what I mean here is that I'm selling through an agent. Okay. So whatever that agent sold, I'm going to pay him commission on it. So you treat a small P&L of that agent's sales. Okay. Let's say if it is 1,000, then the agency fee that you will be paying, which is the commission. All right. Let's say if it is 800 cedis, then you have like 200 cedis. This one is what you've actually derived from your sale. So this is the one that you can bring in. Okay, it's the one that you can bring into your revenue or your other income, or you can record all these 1,000 as revenue and treat this 800 as what? Cost of sale. It comes to the same place. All right, so that is what you need to do. But where you, the reporting entity, is the agent, then your revenue is just your commission. Okay, so that is that. Another thing under revenue that you need to note is sales, the sales with warranty. Sales with warranty. So what happened is that here you are selling, but you tell the people that you have given them a warranty. And that warranty is that you are going to, repair something for them when it gets spoiled. Those of you who buy with 2 years warranty, all those things. Okay, so what you are going to do is that you will have to recognize the sale. Everything that you sold, you recognize the sale or revenue. You also need to recognize what? A liability, which is a provision. You need to recognize a provision because you don't know if they will bring it or not. You don't know for any repair because of the warranty. Since you are not so sure, you have a liability because there is a constructive obligation on you because you have given a warranty. So you have an obligation. It's just that you are uncertain about the amount and you are uncertain about the timing. So remember, IAS 37, provision is a liability or obligation of uncertain timing and an amount. All right. So so far as you have given the warranty, you have an obligation, but you actually don't know the number of people who will return theirs for the warranty sake, and you don't know when they will return it within that space. Okay, that 2 years that you gave as warranty. So you will recognize the entire revenue, but at the same time, that warranty aspect, you recognize what? a provision. Okay, so that is that. There is another one called sale or return. Sale or return. Okay, and even that one, there is another one that is like bill and hold. Okay, what you are going to do is that if control of the goods does not pass to the buyer, you don't need to recognize revenue. So unless control is passed to the buyer, don't recognize revenue. All right. So that is that. Unless control is passed on to the buyer, do not recognize revenue. Okay, so that is that. That is that. Another one too is the one that we call sale and repurchase. Sale and repurchase. You sold the thing and you repurchase it again. That one too is the same. If the control of the goods are not passed on to the buyer, do not record revenue. The money that you would take in respect of that, you will have to treat it as what? Loan. Okay, you have to treat any money that you receive from that sale because you've sold the thing. Okay, actually the thing should leave you, control and everything should leave you to the other person, but you repurchase it and it's like the thing is still with you. Okay, that kind of stuff. When it happens, we say that if control hasn't passed to the buyer, do not record revenue. Okay, the same thing here. So unless control is passed to the buyer, don't recognize revenue. So any money that is given to you because of this one, any money that is given to you, you will treat that money as a loan, okay? And if you have to pay interest on it, then you'll be paying interest on it at the date of repurchase, not the sale, at the date of repurchase. The loan will start at the date of repurchase. Okay, so I mean, that is that. And there is another one called onerous contract. I mean, that one is purely like a contract term. Onerous contract is a contract that is positioned in such a way that you already know that you are going to make a loss. Okay, you already know it's a loss-making contract. Okay, so that one you have to stick to. So what? Let me just note that one here. It's a contract that you know that you are going to make a loss. Okay, I think I will treat that one under construction contract when we move on with that. Okay, so that is that. So this is revenue, IFRS 15. There is a second part to it, which is the contract, and I will teach you a 4-step approach to the contract, and probably we take some examples for today. So any question for now with what we've said so far? Any question? Any question? Any question, please?
Please.
Yeah.
The agency sale, the second part, you were saying that we have two types, reporting as an agent and reporting as a principal.
Yeah, when the reporting entity, the one preparing the account, is an agent, it means that the only revenue that you get from agency sale is the commission.
Yes.
Yeah. But when the reporting entity is the principal, then it means that every money comes to him. He would rather be paying the commissions.
Okay.
All right. In that case, you can treat all the monies or the transactions of the sale as your revenue. And the part of the commission you will be paying, you can treat it as a cost of sale.
Okay. Okay.
Yes. Or, so the or is this one. You can separate the part that you are paying the commission on. So if that agent sold 100,000, 1,000, and his commission was 800, you'll be left with only what? 200. If you want to go by this, then you have to add this 200 to your other income after your gross profit. All right.
Okay.
Yeah. So you still end up at the same end point.
Okay.
Yeah. Thank you for that question. Probably someone needed it than you yourself. Yes. Any other question? Any other question, please? Okay. I still open this 5 minutes for questions because you have to rejoin before I move on to the construction contract aspect. Okay. And then we will take some few examples for today. Yes, any question?